Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
All right, let's jump right in. Rocket Companies is trading right in the heart of the action here. It's holding firm around that 1940 mark, anchored pretty solidly within the $19 to 1945 range. And this is all happening after a massive strategic transformation all through 2025. This stock is just incredibly active. We're seeing short interest elevated at about, 4.6% of the float, so roughly 39.5 million shares. And its off-exchange volume, the so-called dark pool trading, is frequently pushing past 40% of the daily transactions. So the core tension that we're looking at here is pretty straightforward. After RKT went on this aggressive pivot, acquiring both Redfin and Mr.
Cooper to become this vertically integrated super app for home ownership. The question is, does the stability they've gained from that massive $2.1 trillion servicing portfolio and a confirmed technical breakout, does that actually outweigh the huge integration risk, the new debt, and the new regulatory constraints that came with the mergers? My position is that this transformation has fundamentally structurally de-risked RKT. And we have confirmation of that in the technicals, specifically that inverse head and shoulders breakout, which I think points to an immediate path toward those $21, $22 highs.
And I think that's the perfect way to frame it, but I'm going to focus intently on the downside of that transformation. Rocket has without a doubt created a more robust model. But in doing so, they've layered on just an extraordinary amount of complexity and debt. So I would argue that the risks, specifically those regulatory limitations, the sheer difficulty of operational integration, and the fact that they're still posting negative GAAP earnings, it all just screams, show me. It mandates a cautious wait-and-see approach, no matter how promising any short-term charts might appear.
I see why you'd think that, and it's easy to focus on the immediate cost and complexity. But let me offer a different perspective on why this complexity is actually, creating value by de-risking the company. Rocket Q is just no longer that cyclical boom and bust mortgage originator that institutional money always hated. It's now a stabilized, integrated platform. That $9.4 billion Mr. Cooper acquisition solves the #1 problem that has historically plagued Rocket: extreme earnings volatility. It delivers that essential natural hedge by acquiring all those mortgage servicing rights, the MSRs, creating that $2.1 trillion portfolio. And MSRs are countercyclical. So when rates are high like they have been, origination volume tanks, but the value of the MSRs goes up and the servicing income Rocket collects just soars. This ensures a stable, high-margin cash flow floor, which is exactly what institutional investors have been demanding for years. And then you have the Redfin deal. The $1.75 billion acquisition there strategically addresses the second core problem: unsustainable customer acquisition costs, or CAC. By owning the top of the funnel, Redfin brings in over 50 million monthly visitors. RKT can just bypass those expensive third-party lead generators. Management is explicitly targeting $60 million in revenue synergies just from pairing Redfin agents with RKT financing, and they expect it to be accretive to adjusted EPS by late 2026. This isn't just a strategy on paper. The market is signaling it agrees. RKT has confirmed a breakout above that 1780 neckline of the long-term inverse head and shoulders pattern. This reversal pattern suggests a measured move target immediately north of $20.68, which shows that the structural shift is translating into real technical momentum.
Okay, that is a compelling articulation of this strategy, I'll give you that. But the transition from a pure play originator to this integrated super app comes at a steep, very tangible cost that I think your thesis tends to glide over. My position is still rooted in the reality of execution and the balance sheet constraints. First, we have to talk about dilution and leverage. These were almost entirely all stock deals. That led to significant dilution and a heavily increased leverage profile. Just servicing that increased debt load puts enormous pressure on the P&L and makes profitability that much harder to achieve. Second, and this is maybe the most important point, the integration execution risk is paramount. You're attempting to merge three fundamentally different corporate cultures. You have the high-octane, high-pressure Detroit sales culture of Rocket. Then you have the measured, process-driven Dallas servicing focus from Mr. Cooper. And then there's the highly decentralized, tech-centric agent model of Seattle-based Redfin. I mean, this isn't a merger. It's an attempted corporate fusion across completely distinct geographies and operating philosophies. If they fail to execute on even a fraction of the projected $500 million in annual run rate synergies, that stabilizing MSR income will be completely swallowed by integration costs and rising interest expenses. And finally, the structural headwinds are severe. We've got ongoing FTC scrutiny over Redfin's past rental agreement, which creates real headline risk. But more importantly, the FHFA approval conditions for the Mr. Cooper deal place a hard 20% cap on RKT's future agency servicing growth. They can't just buy their way to expansion forever. That regulatory ceiling forces them to focus internally on extracting value through cross-selling, which is the very thing the integration risk threatens to undermine. The Q3 2025 GAAP net loss of $124 million on $1.61 billion in revenue clearly shows that right now, the costs of building this super app are just overwhelming these strategic benefits.
I acknowledge the Q3 GAAP loss, of course. That's certainly the consequence of a large-scale restructuring. And I agree that execution is the central, non-financial risk here. However, let's not lose sight of the sheer magnitude of the fundamental de-risking from that MSR portfolio. That $2.1 trillion asset base provides a financial bedrock that minimizes the catastrophic impact of future macro cycles. If rates stay high or even go higher, the company is cushioned. The market can, and it often does, look past temporary integration costs when the long-term profitability profile, which is now structurally less volatile and therefore more attractive to large funds, is this clearly improved. The key volatility factor, the one reason institutional money would sell every time the Fed sneezed, has largely been mitigated. This changes the whole investment case from a cyclical momentum trade to a diversified platform investment.
And I'll grant you the MSR stability. It is the most robust, valuable piece of the whole thesis. It's a brilliant counter-cyclical hedge. It's basically an insurance policy against high rates. However, even taking that into account, we still have to ask, what is the purpose of the Redfin piece? The MSR portfolio generates value no matter how well the super app vision performs. But the $1.75 billion spent on Redfin is entirely dependent on successfully stitching together that cross-selling flywheel. If Rocket can't convert those 50 million monthly visitors into profitable loan originations, then that huge capital expenditure becomes dead weight. It increases complexity and distracts management without providing any core strategic value. And we're already seeing signs of internal friction. We've seen class action lawsuits pop up concerning inadequate disclosures around the Redfin deal. Now look, lawsuits are part of business, sure, but they are symptomatic of internal friction, and more critically, they demand management's attention. At a time when RKT needs laser focus on integrating three distinct operating systems and cultures, they are getting bogged down by litigation. It's like trying to get three different proprietary software programs, each with its own legacy code, to run simultaneously on one massive shared server. It is just prone to crashing.
That analogy captures the operational challenge vividly, and I'll concede the legal friction and the cultural integration are real headwinds. They require careful monitoring. But let's pivot back to the technical reality you dismissed, because it directly challenges this idea that RKT is currently pinned. You brought up the breakout at the 1780 neckline, so why is the stock just consolidating between $18 and $20 instead of immediately running toward that 2068 target?
Well, this isn't solely about operational friction. It is a structural supply absorption phase. I'm sorry, I just don't buy that the technical strength is robust enough to overcome the fundamental supply dynamics. Let me tell you why. The narrative here is simple supply and demand. The massive share issuance from the Up-C collapse and the all-stock mergers just flooded the market with paper. And just to clarify for everyone, the Up-C structure was this complex corporate mechanism that allowed the founding family to hold shares through private entities. When that structure collapsed in June 2025, those private holdings converted into freely tradable Class A shares. You combine that with the stock issued for Redfin and Mr. Cooper, and the increased supply of tradable shares hitting the market is a massive structural headwind. That increased share count explains exactly why the stock is just churning in this $18 to $20 range. You simply cannot ignore that high-volume supply dynamic.
See, I would frame the impact of the Up-C collapse entirely differently. It wasn't dilution in a destructive sense. It was corporate simplification that dramatically improved the investment profile for passive funds. While it's true the collapse increased the number of Class A shares, more importantly, it drastically increased the public float, the number of shares available for public trading. Why does that matter structurally? Because major passive index funds, the huge entities that run ETFs tracking benchmarks like the Russell and the S&P 500, they operate on a rules-based system. RKT's new, larger weighting in these indices, thanks to that bigger float, requires these multi-trillion-dollar funds to increase their holdings. This mandated, persistent buying from passive index funds creates a structural, continuous bid for the stock, which is designed to absorb the very supply you're worried about. Validation isn't weakness. It's the market efficiently absorbing that new float and base building to establish a higher launching pad before the next move toward that 2256 high.
That's a powerful argument for structural demand, I'll admit, but it relies on index rebalancing over time. Meanwhile, management has to deal with the very real regulatory ceilings you mentioned. That FHFA 20% cap is a huge limiting factor. For context, the FHFA imposes this to ensure no single entity dominates the market for agency-backed mortgage servicing, preventing systemic risk. So this means Rocket is permanently capped at about 20% of the market. They cannot just buy their way to market share leadership. This cap forces RKT to be hyper-efficient. It essentially requires the super app flywheel to spin perfectly. It means every dollar they spend on Redfin, every dollar on integration, must translate into cross-selling success because they can't just accumulate more MSRs beyond that ceiling to paper over operational failures. That regulatory constraint is the gravity holding the stock back until those synergies are proven out.
I agree the cap is a constraint, but I also see it as a forcing function for efficiency. It validates the strategic pivot. If you can't expand market share through acquisition, you have to monetize your existing massive customer base better, which is exactly what the Redfin deal is designed to do. But before we wrap up, we have to address the final contentious point, which drives a significant portion of this stock's volatility, the pervasive retail narrative. You mentioned the short interest. We have to address the rumors circulating among retail traders.
Absolutely. Clarity is necessary here. We have to be clear. The rumor of a reverse split is a complete myth. It stems entirely from public confusion over the Up-C collapse mechanics. It did not happen. Furthermore, while the short interest is high, we need to put it in context. RKT's market cap is north of $40 billion. A genuine, retail-driven short squeeze, like we saw in 2021, is extremely improbable.
The current days to cover is moderate, around 3 days. The actual data just does not support the meme stock narrative. I agree we have to debunk the reverse split and the classic squeeze idea. However, we can't dismiss the retail impact entirely, especially when we look at the trading mechanics they influence.
You cited that off-exchange volume often exceeds 40%. Retail traders claim this is price suppression, but that's a misunderstanding of how their commission-free orders are filled. The reality is that this high off-exchange volume largely reflects retail internalization. When those orders are routed to wholesalers, the trades are often executed in private venues, dark pools, and then reported. High dark pool volume in this case actually confirms high retail activity, which is often heavily weighted toward buying that is just being filled by wholesalers. And crucially, we cannot ignore the tactical potential from the intense retail options activity.
There is high call open interest, with implied volatility running between 36 and 44%. This creates what's called a gamma hedging feedback loop. Market makers who sell those calls are forced to buy the underlying stock as the price moves up to hedge their exposure. So this means that if a genuine fundamental catalyst occurs, like, say, an eventual confirmed move by the Fed to cut rates, the stock's upward move could be dramatically amplified. It creates a tactical entry for aggressive investors betting on a macro pivot.
A potential for a gamma squeeze, driven by an external catalyst like a Fed pivot, is a legitimate tactical possibility. But that's a bet on timing the macro environment, not a bet on management's execution. Without that catalyst, the immense gravitational pull of the integration risk, the FHFA cap, and the sheer supply of shares will likely keep RKT pinned in this current range. absorbing that new float until concrete positive GAAP earnings are delivered. Ultimately, my thesis remains supported by that successful de-risking strategy. The company solved its critical earnings volatility problem with the $2.1 trillion MSR portfolio. The technical analysis gives us clear risk parameters. As long as the stock holds structural support at that 18 to 1847 level, the path of least resistance is higher, validating the long-term super app thesis. And I maintain that RKT remains a profound show-me story. The team has assembled the pieces of the engine, but they have yet to prove they can make it run efficiently while navigating all these cultural and regulatory constraints. The integration challenges, the regulatory scrutiny, and the need for positive GAAP earnings create significant counter-narratives that demand proof of those promised $500 million in synergies. Until that execution is proven, the stock is going to struggle to break decisively above that firm $21 resistance zone.
So we've established that the future trajectory of Rocket hinges entirely on the success of that operational execution, a factor that neither short-term technicals nor debunked retail myths can ultimately resolve on their own.
Indeed. There is substantial value in continuing to analyze the fine print of that integration risk and just how they intend to maximize value within the constraints of that FHFA 20% cap.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.